If you observe the history of markets carefully, you'll notice there's a specific moment in every cycle where people continue spending money on exactly the wrong things. They do this not out of malice, but because they're looking in the rearview mirror instead of understanding the patterns that repeat. That moment has arrived now. In 2026, we're entering a phase of the economic cycle where certain spending categories haven't just stopped making sense, they've become dangerous to your long-term wealth. This isn't a prediction, it's a logical consequence of the incentives that are forming right now. When you understand how cycles work, you realize there's a fundamental difference between spending money during periods of easy expansion and spending during periods of structural transition. We're in a structural transition. Over the next decades, the rules that define the last 40 years of investing and consumption are going to change dramatically. People who continue operating with the old rules will be hurt. Those who adapt to the new rules will have a significant advantage. To understand why certain expenditures have become dangerous now, you need to understand that we're coming out of one of the most extraordinary periods in modern financial history. Between 1981 and 2021, we lived through a super cycle of declining interest rates. When I started at Bridgewater, American interest rates were at 15%. For 4 decades, they fell consistently until they reached near zero. That decline created the largest bull market in assets in human history. Stocks, real estate, bonds, practically everything went up in price because money kept getting cheaper. In that environment, certain strategies worked almost automatically. Buy any asset and wait. Use leverage. Focus on growth instead of value. Spend on experiences and luxury goods because inflation was controlled and assets always went up. These strategies worked so well for so long that they became dogma. People began to believe they were universal truths, but they're not. If you study earlier periods in history, you'll see there are moments when these strategies simply stop working. And when they stop, those who keep using them lose a lot of money. The super cycle of declining interest rates ended in 2022. We can't lower rates anymore because they've been near zero for over a decade. The next structural move will be upward. This means we're entering a new regime, a regime where money has cost again, where leverage becomes expensive, where not all assets rise together, where you need to be more selective about where you allocate your capital. History shows us that these transitions always catch most people unprepared. They continue operating with the old rules while the game has changed completely. In the 1,970 seconds, people who continued buying long-term bonds were decimated by inflation. In the 1,930 seconds, people who maintained leverage were destroyed by deflation. In every transition, there's a specific set of behaviors that need to be abandoned. For 40 years, money had negative or near zero real cost. This meant that any debt finance spending was essentially subsidized. You could borrow to buy anything, and inflation helped pay off the debt. That period is over. Now, for the first time in decades, real interest rates are positive and will likely remain so for years. This fundamentally changes the calculation of any debt finance spending. If you're paying 7% annually on a loan and inflation is at 3%, you're paying 4% real cost. This means anything you buy needs to generate more than 4% real return just to break even. Most consumer goods don't do that. We're at a unique moment where several cycles are converging simultaneously. The technology cycle, the geopolitical cycle, the demographic cycle, and the debt cycle are all changing phases at the same time. When this happens, entire sectors that were good investments become bad investments almost overnight. and spending that made sense for decades stops making sense quickly. AI is changing the value of certain skills and professions. Deglobalization is changing the value of certain geographies. Population aging is changing demand for certain products and services. If you continue spending as if these cycles weren't changing, you'll be caught off guard. During transition periods, scarcity moves. Things that were abundant become scarce, and things that were scarce become abundant. Over the last 40 years, capital was abundant and commodities were relatively scarce. That's why it made sense to leverage capital to buy real assets. In the coming years, capital will become scarcer and certain commodities may become more abundant due to technology. This completely changes where you should allocate your resources. Let me give you some concrete examples of how these principles apply in the real world. Imagine a five-year-old couple, the Thompsons. They have $500,000 in assets and are thinking about buying a $300,000 vacation home with financing. For the last 20 years, this decision would have been obvious. Vacation homes only went up in price, interest rates were low, and leverage amplified gains. But now let's do the numbers with the new rules. The house cost $300,000. They put down $60,000 and financed $240,000 at 7% for 30 years. The monthly payment is $1,600. During the first years, practically all of this payment is interest. So they're paying about $16,800 per year just in interest, or 3.4% of their total assets. For this vacation home to pay off, it needs to appreciate at more than 3.4% annually, plus maintenance costs, plus taxes, plus inflation. Historically, real estate appreciates approximately in line with long-term inflation. If inflation is 3% and the house keeps pace, real appreciation is 0. But they're paying 3.4% real cost annually. The net result is negative. Now, imagine that instead of buying the vacation home, they invested that $60,000 down payment in assets yielding 5% above inflation. In 10 years, this would become approximately $98,000 in real purchasing power. The difference between the two strategies is significant. This same pattern applies to spending that seemed obvious under the old rules but becomes traps under the new rules. Stop financing cars, boats, furniture, electronics, and any goods that lose value over time. For decades, these purchases made sense because interest rates were low and wages grew consistently above inflation. You could finance a car knowing your salary would increase faster than the payment. Now, interest rates have risen and real wages are stagnant for many professions. Any debt for depreciating goods becomes an anchor on your wealth. If you need a car, buy used and pay cash. If you don't have money to buy cash, you don't have money to buy the car. Similarly, stop buying real estate in areas dependent on industries being automated or in regions vulnerable to extreme climate change. Many people still think of real estate as a universally safe investment, but not all real estate is equal. AI and automation will concentrate high-quality jobs in certain regions and eliminate jobs in others. If you're thinking about buying a house in a city that depends mainly on traditional manufacturing or office work that can be done remotely, you're betting against technological trends. Likewise, coastal areas vulnerable to rising sea levels or regions prone to extreme droughts may see their real estate values pressured in the coming decades. Stop spending large amounts on expensive traditional education for fields being rapidly automated. Many families still operate with the mentality that any college degree is a good investment. But the job market is rapidly polarizing between jobs requiring highly specialized skills and jobs requiring complex human interaction. Jobs in the middle, basic administration, simple data analysis, many forms of marketing are disappearing. If you're going to invest in expensive education, make sure it's in an area where humans and AI complement rather than compete. Also, stop buying stocks of companies being priced for a world that no longer exists. Many companies are still being valued as if they would grow at the rates of the last 10 years in an environment of near zero interest rates with increasing globalization. That environment is over. Companies that depend on cheap leverage, that lack technological adaptability, or that are vulnerable to geopolitical changes are being incorrectly priced by the market. Stop spending money on expensive items that are primarily for status demonstration and that lose value quickly. Expensive watches, designer clothes, latest gadgets, all these expenses made sense during decades of growing prosperity and low inflation. But in an environment where capital has real cost and where you need to be more selective about resource allocation, spending money on status is a luxury few can afford. Every dollar spent on an item that doesn't generate returns or provide essential utility is a dollar not being invested in your adaptation to the new economic regime. Now that you know where to stop spending, let me give you specific guidance on where to reallocate these resources. Instead of financing depreciating goods, use that money to buy assets that maintain real value over time. This includes commodities, real estate in privileged locations, stocks of companies with pricing power, and some forms of real money like gold. The key is diversification. Don't bet everything on a single asset class. Distribute among different forms of value storage that historically perform well during inflationary transitions. Instead of spending on expensive traditional education, invest in developing skills that complement AI. This can include specific technical skills, complex relationship skills, or creative skills that machines can't yet replicate. The important thing is to focus on continuous learning instead of betting on a single credential that might become obsolete. Instead of betting all your human capital on a single career or company, develop multiple income sources that aren't correlated. This can include investment income, side businesses, royalties, or skills you can monetize in different ways. The idea is to create anti-fragility, an income portfolio that gets stronger during turbulent periods instead of weaker. Instead of leveraging everything available, maintain a significant portion of your wealth in liquid form. During transitions, opportunities appear quickly for people who have available capital. If all your money is tied up in illiquid assets or debt payments, you can't capitalize on these opportunities. A good rule is to maintain at least 20-30% of assets in forms you can access quickly. All these changes are happening over a 20 to 30 year horizon, not 2 to 3 years. This means you need to be patient with the right investments and persistent in avoiding traps. The market may take several years to fully price these transitions, but when these transitions become obvious to everyone, it's too late to position yourself. Be extremely conservative with most of your wealth and extremely aggressive with a small part. 90% of your resources should be in safe, diversified investments that protect against different scenarios. 10% can be in high risk, high return bets related to the changes happening. This structure allows you to participate in big opportunities without risking your fundamental financial security. If you observe history carefully, you'll realize the greatest fortunes aren't made during stable periods. They're made during transitions by people who can see changes before they become obvious to everyone. We're living through one of these transitions now. The next 20 years will be fundamentally different from the last 20 years. The rules that define financial success during your adult life are changing. Behaviors that created wealth for decades may destroy wealth in the coming decades. This isn't cause for panic, it's cause for adaptation. Human nature makes us want to keep doing what worked in the past, especially when these strategies worked for so long they became part of our identity. But markets don't care about our identity. They reward those who adapt to new realities and punish those who cling to old ones. The good news is this transition is happening slowly enough that you can adapt if you start now. You don't need to make drastic changes overnight. You need to make consistent adjustments over the coming years. Stop financing depreciating goods, reduce your exposure to overvalued assets, avoid expensive debt, invest in your own adaptability, build multiple income sources, maintain liquidity for opportunities. These aren't complicated strategies. They're sensible strategies that work especially well during transitions. The difference between who thrives and who suffers over the coming years won't be intelligence or luck. It will be discipline to apply time-tested principles even when they seem to go against the common sense of the moment. The common sense of the moment is still operating with the rules of the last 40 years. The rules have changed. Those who understand this first will have a significant advantage. History doesn't repeat, but it rhymes. And now it's rhyming with earlier periods of structural transition, where those who adapted prospered and those who resisted suffered. You have the information necessary to make the right decisions. The question now is whether you'll have the discipline to implement them. Remember, this isn't a prediction. It's a logical consequence of the incentives forming now. And if you understand the incentives, you understand the behavior they'll generate. Use this understanding to your advantage.